So when are we going to use long puts? Whenever we think the stock is going down. If you think the stock is going down, a lot of you, I've seen day traders, a buddy of mine's a day trader, and one day he was just flipping through some charts, and I was standing next to him. And he's sitting there and he's looking, and he says, no, I don't like this chart. This stock's going down. He flips to the next one. I don't like this one either. The stock's going to get killed. I don't like this stock either. He must have gone through 10 or 15 stocks that he thought were going down. And he passed right by them. He was sure they were going down. Then he comes up to a chart and he goes, you know what? This doesn't look too bad. There's a shot that this thing's going to go up. And he traded that. Why? Because he wasn't able or comfortable enough with the risks of shorting stock. If he just knew how to use a put, he would have never, ever had that problem. He could have simply bought a put and made money off the first 15 charts that he went through instead of trying to opt for a potential upward movement that he wasn't nearly as confident in as the downward movements. It's a two-way street. And with the use of the put, the individual investor has the ability to now travel in both lanes. We can trade up with confidence, with security. We can trade down now using long puts to trade with that same confidence and security. No longer do we have to take choice number 23 because that's the only bullish choice. We can take these trades that we feel are definitely going down without being in a risky situation, without putting out tons of money for margin to short a stock. We could just simply buy the put. You think the stock's going down? Don't short the stock. Buy the put. For any reason you think the stock is going down. It's not like, hey, I think the stock is going down, but because it's going down for this reason, I better short the stock instead of buying the put. No. You always buy the put instead. Here's another thing. Try to short Apple. I'm not even going to mention Google and some of those others. Try to short Apple. See how much money you have to come up with to short Apple. You might know Apple's going down. You might be so confident that Apple is going down that you sell your kid to play it. Here's the problem. You just might not be able to short Apple. It might just be too expensive for you to short it. You don't have enough money up for margin. You don't need to worry about it. Using puts to replace the short stock is ideal. Textbook, made for your ability to short a high-priced stock. If you can't get that margin, you use the put. Puts don't have margin. You just buy them. They're not real expensive. Remember that cost efficiency thing we talked about? We don't have to worry about our margin requirements. We just buy a put. It's that easy. Whatever type of technical analysis you do, whatever you look at, and you say to yourself, this stock's heading down, definitely, buy the put. Doesn't matter the price of the stock. You're going to be able to buy a put. The other thing is, and probably the most important thing, is when you already have a big profit, the stock's going down, you sit there and you scratch your head and say, I don't know, it might go down more, but I've got so much profit, I want to take it. If you have a short stock position, what are you going to have to do? You've got to buy the stock back. You've got to diminish your position. You're not going to be able to be along for the full ride. My guys, several of them, caught the full ride to zero in Bear Stearns, caught the full ride to zero in Lehman. I think a couple even got Fannie and Freddie that didn't go quite to zero, but $1.10 or 78 cents, wherever they're trading, is close enough to zero. Why were they able to get the full ride? Because when they looked at their long put position, they said to themselves, I don't have a lot of risk. Why? They used the rolling technique. They rolled their puts down with the stock, and we're going to go over that. They rolled their puts down with the stock, each time locking in profits and limiting their risk. They limited their exposure. So they were more than happy to let the thing ride because they didn't have a lot of money in the game at the time, because they had just rolled down. Rolling, the ability to lock in profits without diminishing your position, is gigantic. If there's one single argument that I can put forth to my stock trading buddies and get them to sit there and finally say, all right, Ron, just to shut you up, you're right. This is the argument. That's the one I never lose with, because they can't do this. A stock trader can't do this. That's why the options are superior. Now we come to chart identification. What we need to do is figure out how we're going to find, or what we need to look for in the charts to identify good opportunities to use the stock replacement strategy. Either some type of upcoming up movement where we're going to use the long call to replace long stock, or some type of downward movement that we feel is coming where we would use the long put to replace the short stock. So let's take a look at how we're going to identify these opportunities.
All right, well, you did an excellent job. I'm proud of you.
Well, thank you very much. I appreciate that.
How do you feel?
I feel real good.
Good.
I mean, real good.
Can you keep going?
I think I have a little more in me. Just a little bit.
All right. Well, for the viewers at home, I think that you can tell that Ron's got plenty of energy to go around. So the first thing that I want to do, though, is I know you've already covered it, Ron, and I just want to go over it because it's the number one most important thing that you have to think, maybe tied for first, for the most important things you need to, what is it, Ron? How can I help you?
Number two.
Peace.
It's number two.
Oh, two.
Not number one.
Why?
Because number one is the ability to roll. Because when you're rolling, you're locking in profits while maintaining the same size position. And it's something you can only do with options, and it really allows you to follow something and let your winners run.
However, what happens if you don't have the money to do that because you wiped it all out through leverage, over-leveraging yourself, using options for leverage instead of safety? Then what are you going to do?
Well, if you were rolling the whole time and you're also limiting your losses, then you wouldn't...
Taking money off the table?
Yeah, you wouldn't have lost all your money.
Yeah, good point.
Yeah.
Okay, well, you win this time.
I appreciate that. So now it's 10 for you, 1 for me.
I won't be so kind
that.
next time. Well,
Promise.
Ron got lucky again. He's a lucky guy. But what we're going to do now is, before we move forward, I just seriously want to say that use these strategies that Ron is talking to you about for safety versus leverage. What happens to some of the most sophisticated investors out there, the reason half the hedge fund industry is currently evaporated, is because they fall into this trap and they use leverage and they start to get greedy. They find out with these strategies that you could take a certain amount of money and you can make a couple 100% on it in just a couple of weeks. And what happens then is you take a whole bunch of money, and then what happens usually? Second time.
That's when you always lose.
Right. Murphy's Law. It's like when you go to the casino, you bet 20 bucks, and you come out with 1,000, and then you take all the money in your bank and wipe it out, which I would know nothing about at all whatsoever.
Sounds like you're speaking about the little experience, huh?
I was young. I was experimenting.
Well, one of the things that you have to understand is that leverage comes with two definitions. And one definition, which your broker probably would love you to, adopt, would be the same amount of money, but a much bigger position. And that's the one you're talking about that the hedge funds fell in the trap of.
Right.
That's not the type of leverage an individual investor should be using. It's the second definition of leverage, which is same size position, less money. And with less money comes less risk.
Right, and by same size position, what you mean is if you usually trade maybe 100 shares of a stock, then you might trade 1 or maybe 2 options to replace that.
Yeah, and we talked about that. We talked about the idea of how much money to spend on options, and we said that there's a conventional calculation, and the conventional calculation states that, hey, for every 500 shares that you would have bought, you might buy 5 calls in that 1-to-1 ratio.
Right, or maybe even 6 calls, maybe something to get you up to 500 deltas.
Well, you might go ahead and do that. There's nothing wrong with that because you know that with your options, you have a limited fixed loss.
Right. Okay.
So you could extend it a little bit, knowing that you can't get killed.
A little bit of leverage.
Doesn't hurt anybody.
All right. Well, so that's it. And just last side note here before we go, there's a couple of different ways that you can take these different strategies that Ron is showing you and position yourself in your account and structure your account. Number one is the way that I like to do, which is basically taking both bullish and bearish positions at the same time. You might be 80-20 bullish or 60-40 bearish, depending on the market. But let's just say you're somebody who only takes bullish positions. There's another trap that I don't want you to fall into, and some people do. They say, well, usually I know I'm not going to take $10,000 that I usually put into a stock and then plug that $10,000 into one stock replacement position. But what they do instead is they take several stock replacement positions. They take that same $10,000 and divide it amongst maybe 5 or 6 bullish positions, using the entire $10,000 to take a bullish posture in the market. What happens then is you're wrong about the market's direction, and you can get flattened that way too. So what we want to do is make sure that you stay in the game and that you make lots of money, and you do it in a safe way. So what you want to do, if you're going to do some stock replacement, you normally put $10,000 into a stock position. Put a fraction of that into the stock replacement strategy, and keep the rest maybe in cash or in a tin can buried in your backyard if you don't have any dogs that are exploring your what.
I see you sneaking around people's yards all the time, digging up those
They don't
tin
have
cans.
to
Is that
know
what's
about
going on?
They don't need to know about that.
Blaming gophers. Unbelievable.
I'm going to have these people in my backyard now.
Well, that's because
up my
all their
can.
money is still in there.
Well, I'm gonna change my hiding spot. It's not under my mattress, if that's what you're thinking. And so, what do you think? We should probably show the people at home now how to when to take these positions.
That is definitely the next step. They've got to know when to put these positions on and what
Right.
type of charting pattern that they come across. That that they could say, hey, this is a perfect opportunity for the stock replacement strategy. And being that you are a market technician. And this is where you are. This is where you are the master.
Where I like
Maybe
to
you
be.
can go and show these people how to find either trending upward movements or breakout, breakdown, trend down movement. Show them
right.
how to find movement.
No, or lack thereof. Now, Ron just showed you some basic option strategies. I'm going to show you some basic technical analysis strategies that you're going to use to identify the best times to implement the strategies that Ron's talking about. Let's start with stock replacement.
Oh, you've got to go do work now?
I'm going to do some work today.
Oh, there's a change. All right, well, why don't you go do a little work
All
for
right,
a change?
I'll go get them.
Thank you. I
All
appreciate
right.
that.
Take care.
See you.
See you then. Bye. Okay, now to go over a strategy, stock replacement using calls. So instead of buying a stock or buying an ETF, what you're going to do is you're going to buy in-the-money call options. First thing you're going to do is you're going to identify the chart, and you're going to identify the parts of the chart that have key price points. And you can see obviously the stock found some support right here, so we extend that out. Past these, these other times where that support was tested again, and the more it's tested, the more valid it becomes as a support level. These are the things that just jump out at me immediately when I look at a chart like this. We see that there's a positive divergence right here where the RSI made higher lows while we made even lows right at this point. And remember, we want all these different signs to coincide with each other right around the same price points. So we can see that there was some support here. Stock bounced off of that support, established itself as a proven support level, did the same exact thing again and started to bounce. Now, when that happened, we noticed that there was an RSI buy signal, and there was a positive divergence in the RSI. This is when I made the recommendation to TrendRider members to buy deep in the money call options on the Oil Service Holders Trust. It's an ETN, an exchange-traded note. So what I did was I established these key price points, and I saw that it found resistance twice right here, or maybe even 3 times. So you're going to extend that price point out too. Then we had a breakout. Now, when this level of resistance that was established right here was penetrated to the upside, we knew we had a breakout in OIH, and that's when I made the recommendation at the TrendRider to buy the call option. Once that happened, we can establish that this was an old resistance level right here, turns into a new support level right here. So whenever you have resistance levels or support levels that are established, extend them out in the chart. And you can see that it even proved to be a resistance level as much as about 6 months later in September when the stock broke down. It tried to rally back up, but we remember that this was a key price point here that we extended out, and we knew that that was where you're most likely going to find some resistance. That's another story. You could have taken a bearish position at that point. But what we did at the TrendRider was we took a bullish position right here, and we found a trend line. What we did was we connected this low, where we also established that there was horizontal support right here, and we connected to the next higher low right here. Also coincides with this horizontal old resistance and became new support right at the same point. So you established all the key price points. Let me just rewind for a second here. You can also notice that as soon as the stock failed to find some support right here at this uptrend line, it broke down and then found some resistance right at that uptrend line right here. So basically what we did was we took the position once we established that there was a breakout right here. We established there was an uptrend line. We drew the uptrend line. And we also, we held on to this for a while. We made a nice profit. We were up about 55% or something like that at the Trend Rider. What we saw, though, was we found some resistance over here, and we basically drew the line where there was old support, new resistance, then some resistance right here. And the candlestick pattern that you see right here is an inverted hammer, and that's a very bearish candlestick pattern that you see right there. Happened to coincide right here at the same key price point. So what I did was, instead of exiting the position, because I was still kind of bullish on it, was I turned it into a diagonal call spread, and that limited my upside potential. So you could see that while I initiated the diagonal call spread, the stock did run ahead. And obviously, hindsight's 20/20. I would not have initiated the diagonal call spread. So we only made about 56% in just a couple of months, which is still pretty good. But you can see that there's no sell signals here in the MACD. There's no sell signals here in the RSI. That should have been the reason that I stayed in it. Instead, I initiated the diagonal call spread because I wanted to be a little bit more conservative in a market that just looked disastrous. So what I did was I hedged right here. Stock ran higher. I could have made that big, extra gain. Probably would have been about an 85% return instead of about a 55% return. But what I did was I hedged the position, and I decided to play it safe in 2008, which wasn't a very bad idea in 2008. All these different price points coincide with each other, and that's the key, is to focus on the key price points and see when a whole bunch of signs are all saying the same thing at the same price, that's when you act. And that's how you take advantage of stock replacement when it comes to a bullish move. You buy in-the-money call options instead of stock, a lot less risk, a lot bigger reward. Okay, well, let's go over a chart where I did stock replacement strategies in terms of a bearish position. So I used a put option to replace a short position in the stock. Here we have American Express. The first thing that we're going to do is we're going to identify some of the key points on the chart. First thing I look at is this. What I'm going to do is try to extend the line out and see if I can find trend lines here. Now here's a small trend line that I found within a large downtrend. And also I'm going to take this and I'm going to extend it out further, and I'm going to find that this top is most likely going to reverse lower because the stock is probably going to find some pressure right here. I know that from connecting these tops and extending that out further. You can see that there was some support right here that was consistently broken and broken again. Again, just to give you perspective, this is one full year. Here's 2008 January, 2009 January. And what you want to do is you want to find all the different signs that all point to the same thing. You might notice that this trend line actually extends out so far out here that it's most likely that we're going to find some resistance there at about 30 bucks. Well, let's take a look at some of these other key price points right here where the stock had found some support, and old support becomes new resistance. As you can see, we found some more resistance right here, and it coincides with this downtrend that we extended out. So we know that this is a likely place that would be a great entry point for either a short stock position, but if you're like me and you're smart and you don't like to short stocks, what you do is you replace them, and you replace this one with a put option that's in the money. Deep in the money put option to replace your short position. A lot less risk and a lot bigger reward. Now you can see that the stock obviously found some support right here. What we do is we just extend that out, and we know that once that support level is broken, this support turns into new resistance levels. And you can see that the support that was bounced off 2 or 3 times here was then bounced off of as resistance 4 more times right here. These were key price points, and it gave us a heads up. Now, I actually played this position. What I did at the Trend Rider, my options trading service, is I recommended put options right here for stock replacement. I'll show you exactly how it was done. You could see that many times the stock found some support. Even though it broke through this black line that you see here, it broke through and found some resistance at that black line. There was lots of support levels tested. There's lots of times where the stock tested this one support level, and then that was cracked right here, and it was cracked on increased volume. So that's when I took the position at the Trend Rider. What I did was I bought in-the-money puts, deep in-the-money puts. I made 120% in the matter of 3 weeks when the stock market collapsed. So while everybody was out there running around like a chicken with its head cut off, we were making money at the Trend Rider on these bearish positions. So the ideal entry points would be right here where the downtrend line coincides with this horizontal resistance, old support. And right here, where it did it again, you can see that there was a key price point here where it also coincided with this long-term downtrend. So the last thing I'm going to do is I'm going to show you something. You can see here this was a key price point because you also got an RSI sell signal. You also got a MACD sell signal that coincided at the same time. I took the position at the trend rider right here because while we broke through the support level, we ran back, and that becomes the new resistance level. What you want to do is find some levels of safety. We also know that this is a key price point right here, so if I was wrong, which I was temporarily, the stock broke out but then found resistance right here. That was my safety net. And that's the way you go about replacing a short position with a put that's in the money. Stock replacement on the short side.
Check out how Ron matches options to Chris's analysis. We've got a bonus video online for you now.
So, how'd I do?
You did phenomenally well. I'm very proud of you. I'm actually very excited to see that you do a little bit of work.
Yeah, well, every
on
now
occasion.
and then, yeah, I stop manipulating everybody else into doing all the work for me, and I break down.
It's a true
and-
skill you have, though.
Yes, I'm very good at it.
Well, now that people have found a way to find these opportunities,
Yeah.
you know, is there anything in the technical analysis that we're going to be going forward with that you want to mention now? Stuff that they need to know and stuff that's going to be consistent throughout what you do and the way you do it?
Well, first of all, everybody just understand that it's always good to use fundamental analysis too. The fundamental analyst basically is saying that he or she is right while everybody else in the world is wrong, and that, you know, can be the case. But when you're using technical analysis instead of fundamental analysis, it's telling you what and when as opposed to why something should happen. And I think, you know, since everybody follows a lot of the same things when it comes to technical analysis, it becomes a self-fulfilling prophecy. So when you see these signals that millions of other traders in the world see, you can act on them because you can bet that they're going to act on them. So there's that. And taking a synergistic approach to technical analysis.
So what you're saying is that you like to use multiple types of technical analysis and look for confluences between them. And
confluences. See, I said synergistic approach, and now you have to use big vocabulary words too, huh?
well, I just have to show you that whatever word you can use, I can use some big words.
Right.
And then from there, all of the different types of technical analysis that provide those confluences, they're all non-correlated, which I noticed.
Do you have those words written on your hand there?
No, they're actually on this monitor down here. You don't see them?
Okay.
And what you were able to do is look for all these types of things all coming into the middle. How's that? I won't use the term confluence.
Right. Well, I'm going to say it like this. Taking a synergistic approach to analyzing a stock chart. There's a lot of other things that you want to look at, what the sector's doing. So you have, like Sector Hunter, for instance, it can tell you what a sector is doing, and you want to nail down what's going on within that sector, the strongest stocks within the sector or the weakest stocks within that sector. And that's how you're going to come to your, you're going to weed out a bunch of individual stocks and which ones you want to trade. When you take a synergistic approach, you're using the sector activity, you're also using the chart, you're using a lot of different things. And if everything points, or at least 8 out of 10 of those things that you check out normally point to the same thing happening or probably happening, then you've got a synergistic approach to investing, and that's what you have to do every time. It's the most important takeaway that I can give you from technical analysis.
Well, now that you've shown everybody how to find, you know, up and down, both trend and breakdown, and we have on our stock replacement position, it's time to talk about how we're going to manage it, how we're going to adjust it as the stock moves, as volatility moves, and as time passes.
And all the variables change, because like we said, with options, there are a lot of different variables that go into how an option gets its price, why it's priced that way. And when the underlying stock or ETF, if you're trading ETFs, when the underlying security moves, all of those other variables tend to change. So you're going to show us now what to do when those different variables change, how to maximize that potential?
We're going to be talking about management of the position right now.
Good. Good. Well, I'd like to see that.
Then I'll go get started.
Why don't you show me?
I will.
Okay.
Okay, now that we know how to identify the opportunity, we now have to apply the proper strategy. There is an option selection process Understand that not every option is built for every potential strategy. The stock replacement strategy works best with a certain particular type of call or a certain particular type of put. Your success in trading this strategy could potentially rely in your ability to pick the right option. We've said a couple times now that some of us have bought a call expecting the stock to go up. The stock goes up, but our call loses money. Is it because options are rigged and they're a fixed game and the specialist screwed me? No, it's not. The broker didn't get my order in time? No, it's not. It's the fact that not every option, put or call, was built for stock replacement. Not every option is ideal or optimal for stock replacement. The problem was you picked the wrong option. Now, if you weren't trained in how to find the right option for stock replacement, this mistake is very common and very understandable. After this section, I don't want to hear any one of you come to me and say, hey, Ron, I thought the stock was going to go up, so I bought a call. The stock went up and I lost money. That won't happen after this, provided you do it the way we're showing you. Trading long options. Let's talk about that. First, let's talk about leverage. See, this term leverage has been used negatively. Leverage is not a negative thing. Leverage can be incredibly productive. When used improperly, it can be just as destructive. The problem is how we use leverage, not leverage. Leverage is an innate object. How we use it determines whether or not it's good or bad. Two definitions. Definition number one, same money, bigger position. Bigger position indicates more risk. If I use the same amount of money in my stock replacement strategy as I would have used in my stock position, I'm going to have a much bigger position, but I'm going to also have much bigger risk. The definition individual investors should be looking at is this second one. This is the right use of leverage. Same size position, less money. That's the type of leverage we want to be talking about. Same size position, ability to make about the same amount of money, but less at risk. That is the proper definition of leverage. This first one was built by people that wanted you to spend big money with them. I'm not going to say who that group of people is. It's got something to do with Wall Street, but I didn't say that. Wall Street wants you. Now I'm saying it. Wall Street wants you to spend as much money as you can. They want you to give them everything you have. You get a bigger position, but now you have bigger risk. And as we see, we get much bigger losses now, don't we? I'm telling you that the proper use of leverage for an individual investor is same size position, less money. Let's focus on that definition. Because everybody always says, hey, how much should I spend on my option position? Well, we've got to realize that $1 spent in the stock market is not the same as $1 spent in the option market. Let's say I buy 100 shares of a $100 call, a $100 stock. How much have I spent? $10,000. Where does the stock have to go for me to lose every penny of that $10,000? It has to go from 100 down to 0, dead flat 0. If the stock trades from 100 all the way down to 0, I lose all my money. Odds of that are pretty remote. However, if I spent $10,000 in buying the 90 strike call, then once the stock went from 100 down to 90 and below, I will have lost all $10,000. So the stock doesn't have to move as much for me to lose the entire amount of money in the options than it does if I own the stock. So you might be saying, well, wait a second, Ron, you're supposed to be teaching options, you're supposed to be a proponent of options, and you just gave me a reason why I don't want to trade them. That is not correct. See, you are using this definition of leverage. Same amount of money, bigger position. I'm going to use the second definition. Same position, less money. There's two types of calculations to use to figure out how much money you should spend on options. One is called the conventional risk calculation. If you were going to buy 500 shares of stock, the conventional risk calculation says 500 shares of stock equals 5 options, 5 calls. Why? Because each call is worth 100 shares. If you buy 5 of them, you've got control of 500 shares. That's the same sized position as you were going to buy in the stock. You were going to buy 500 shares, we buy 5 calls because that's worth 500 shares. That's the conventional risk calculation. If you were going to buy 700 shares, you buy 7 calls. If you were going to short 400 shares, you buy 4 puts. Very simple calculation. Make the amount of shares equal in both the stock position and the option position. Conventional risk calculation. And what you'll see is you will have a lot less money up. That means a lot less money at risk when you do the conventional risk calculation instead of buying the stock outright. Here's the other calculation that I kind of like, and since I haven't read it anywhere else in a book or heard it, and I think I kind of thought it up, I'm going to go with Ron's risk calculation. Why are we calling it Ron's risk calculation? Well, because it's not called anything else, so I might as well take claim to it. Ron's risk calculation. Here, we've balanced our shares. We've balanced our position size with the conventional risk calculation. But in Ron's risk calculation, I'm not going to balance the position size. I want to balance the amount of risk. Let's say we were going to buy that stock, 100 shares of stock, of $100 stock. And we say, okay, I bought my shares. What's my next move? Well, for you stock traders out there, you know what you're going to do right now. You're going to get your stop order in immediately. The first thing you do after you get that stock purchased, my stop goes in. That's good, prudent risk management. Not going to help you overnight, but it will help you during the day while the market's open. Okay, so I bought my 100 shares at $100. You know what? I'm willing to lose $10 a share. I know that the stock fluctuates. This stock's a little wild. I need to give it room. I'm going to set my stop order at 90. If the stock gets down to 90 and I've lost $10, that's it. I'm out. The stop order will sell my stock for me at 90. At that moment in time, when you put a dollar price on your stop order, you've just put a dollar price on the amount of money you're willing to lose. We know that that stop order doesn't guarantee that we're only going to lose $10. Why? Because we go to bed with a $100 stock and a $90 stop order in there. We wake up the next morning, the stock's at $50. What does our stop do? It sells the stock at $50 for us. We only wanted to risk $10, we just lost $50. Stop orders don't work on the opening gap. So, if I only want to lose, or I am only willing to lose $10, how do I somehow guarantee that I can only ever lose $10? Think about it. Think about buying options. If I take that $10 and only use that $10 to buy stock replacement calls, won't I be in a position that no matter what happens, I can now only lose that $10? Gap openings, tornadoes, plane crashes, whatever. I can never lose more in an option purchase than the amount of the purchase price. I have just guaranteed that I never lose more than I was willing to lose to begin with. Can't make that guarantee in the stock market, but I can using Ron's risk calculation. So what do? I first figure out the total amount of shares I want to buy. After I do that, I make my purchase, I put my stop order in. I take the dollar amount of the amount of money that I'm willing to lose as indicated by where I bought the stock and where I put my stop order in. I use that amount of money to buy my stock replacement calls or my stock replacement puts. Simple. Now we have a balanced risk scenario. I have now balanced the total dollar risk of both positions. But I've got added value by using the options this way, because now, no matter what, gap opening and all, I can never lose more than what I spent on the options. That means if I control the amount that I'm willing to lose by only spending that amount on buying the options, I can never lose more than that. So Ron's risk calculation basically levels or equalizes the risk of the two positions, except the option position is guaranteed 100% not to lose more than I wanted to lose. The stock position can't say that. Now, what I like to do is I like to do both calculations. And what I'm going to do is I'm going to buy the amount of options that the one that gives me the most gives me. What I mean by that is, if I do the conventional risk calculation that says, hey, you could buy 5 contracts, and then I do Ron's risk calculation that says you could buy 4 contracts, I'll buy the 5 contracts. If I sit there and I do the conventional calculation that says I could do 3 contracts, and I say, okay, let's run Ron's risk calculation, and I see it's going to allow me to buy 7 contracts, then I'll buy 7. What I found is that when we're looking at longer-term options, for you that are longer-term investors, we're going out 6, 9 months, 12 months. Normally, Ron's risk calculation is not going to be the better one. The conventional risk calculation is going to be the better play. However, for you swing traders and shorter-term traders, front 2 months, Ron's risk calculation often works better than the conventional risk calculation. It allows me to buy more contracts with that specified risk parameter. Now, this is all great. I know the stock is going up. I know I have to buy a call. I know how much money to spend. Now I got to figure out which option I'm going to buy. We've got 2 things to consider. Month and strike. Those are our 2 considerations. Do we buy a front month option or do we buy an out month option? Do we buy an in the money, an at the money, or an out of the money option? Let's see. Now, when we're talking about this, we've got to keep this in mind. This is the what strategy? Say it. Stock replacement. We have something specifically in mind here. Stock replacement. We're trying to find a position and construct it to mimic the stock. In actuality, this is a stock trade. For those of you that are stock traders that say, I'm never going to get this spread crap and all this stuff, I understand. You don't need to get that. If you just understand this one strategy, you can remain the stock trader you've always been. I don't recommend you stopping here, but what I'm saying is, if you could just get this strategy down, you will be a much better stock trader because you're going to be much more profitable and you're going to do it with less risk. It's the same trade as a stock trade. We're not trading options here. We're using options. There's a big difference. We're not a trader of options. We're a user of options. We have a position here where we have the same philosophy, just a different strategy. Everything that we go through, every decision-making process that we would make to whether we should buy a stock or not still remains the same. The only difference is now, after we made the decision to buy that stock, before we hit buy the stock, we stop. And we buy the call. Same philosophy. This is a stock trade. Let me say it again for the cheap seats. This is a stock trade. This is a stock trade. All we're doing is using the options in place of the stock to better our returns and limit our risk. Same philosophy. Everything you would do for a stock trade, you're doing here. Just a different strategy. What does that mean? If we are doing a stock trade, we want to have a position that mimics the stock closely. I mean, think of it this way. You're a coach of a basketball team, and your star center, who's 7 feet 6 inches tall, sprains his ankle. You have to replace him. Are you going to send in a guy like me at 5 foot 10.5 inches to replace a 7 foot 6 guy? We have no common characteristics. I might be brighter, faster, smarter, but I'm not 7 feet 6 inches tall. I am not going to get the job done properly. I can't mimic him. Same idea here. We want to find an option that can replace the stock, one that's going to act very much like the stock. That means we've got to go in the money. We need to use in-the-money options for stock replacement because it's the in-the-money option that mimics the stock most closely. Percent change, delta, higher delta, more mimicking ability. A 90 delta tells me that I am going to mimic the stock to 90%. A 9 delta option tells me I'm going to mimic the stock to only 9%. There's a big difference there. Now, a lot of different in-the-money calls. We want to talk about which of the in-the-money calls we want to buy. And that's going to be the 85 delta option. That is the optimal spot. We're not spending too much money by going too deep in the money, but we're also getting away from the at-the-money option, which has a ton of extrinsic value. We don't want to be near that at-the-money option. We want to be away from that at-the-money option, and I'll show you why in a minute. But the sweet spot is 85 deltas. That's where we want to be. If I'm going to buy a stock replacement call, I'm going to the 85 delta call. If I'm going to buy a stock replacement put, I'm going to the 85 delta put. Timing. Our last topic is timing. We need to know which month. Well, when we talk about looking at a chart, we know that we can not only see the up and down movements, the price movements, we can see the movement over time. If we can see the movement over time, we have a good idea of how long the movement's going to take to happen. We want to match our days to expiration of our option with the amount of time we expect the movement. That's the key to the timing. And once we understand the timing and the spot, it's very easy to pick the right option for stock replacement. Well, the question is, why are we choosing the in-the-money option? And actually, the answer is quite simple. Logic. Simple logic. The in-the-money options have a higher delta. And what is delta telling us? Delta is our options stock component. When you think about it, a higher delta mimics the stock more closely. Remember, I told you when we started this, I said, remember, this is a stock trade. It's not an option trade. We're using the option to give us an advantage in the strategy that we're using. So when we're thinking about, hey, I've got a stock trade, we've got to think which option is going to mimic the stock more closely. And that is the in-the-money option. It has the higher delta. But that's not all. Because we are now well versed and well schooled on our Greeks. We know that stock doesn't have any theta. Stock doesn't have risk to the movement of implied volatility, does it? No, but an option does. And we know that when we buy an option, we acquire long vegas. We also know that where vega is highest in the at-the-money option, as we move further out of the money, or more importantly, as we move further in the money, our vega values shrink, don't they? Those in-the-money options are less sensitive to the movement in implied volatility. By picking the in-the-money option, we not only get the stronger mimicking power that we need and want from our option, because we have the heavier delta, the bigger delta, we also have a situation where we are neutralizing a good portion of the vega by choosing an option that also has a small vega. We're neutralizing the vega. We're picking an option with a small vega. And what about theta? Well, the one thing about an in-the-money option we know is it has less extrinsic value and more intrinsic value. Intrinsic being the part of the option's price that's represented by the stock price. Theta, we know, attacks extrinsic value. If we have no extrinsic value, then we don't have to worry about theta. That's the key. That is why, logically, when we're doing the stock replacement strategy, we want to use an in-the-money option, because the in-the-money mimics the stock more closely. It has more of the same types of characteristics that the stock does. It's not a 5'11" guy going in to replace a 7'6" guy. We're going to send another 7'6" guy in there to replace the one that went down. We want to have an option that has many of the same characteristics as a stock does, and you can only find that in the money. Our problem is, and some of the problems that you might have had when you bought the wrong option, is that that extrinsic value that is in the option is going to decay by expiration. Come expiration, that option will have zero extrinsic value. It's only going to have intrinsic value. What does that mean? It means that the stock has to outperform the amount of extrinsic value in the option before we start to see a profit. Now, think about that for a minute. If I have a lot of extrinsic value in my option, like an at-the-money option, which we know has the most amount of extrinsic value, if I have a lot of extrinsic value in the option, then the stock has to move further just to break me even. In that situation, the movement that the stock has to make just for me to break even might have been a movement I wanted to profit from. You take a look at an option like an at-the-money option. How are we going to determine the break even of an at-the-money option? We're going to take the strike price and we're going to either add the actual price of the option to it, if it's a call, or subtract it if it's a put. When we start looking at how far it means that the stock has to move before we make money, you might be looking at a 5% movement, an 8% movement, just to break you even. I want to make money off a 5 or 8% movement. I don't want to be breaking even after the stock has moved 5%. I want to have profit by then. You need to get away from that extrinsic value. The stock has to perform over and above it before you make any money. And we also know that there lies the highest amount of vega and theta. Why would we choose an at-the-money option when it has the most amount of vega while the stock has zero, the most amount of theta while the stock has zero? It doesn't match. It's like sending me in to replace the center, who's 7'6". So, why that in the money? More sensitive to smaller movements in the stock. The in-the-money options, by nature, have lower break-evens. Quick example, let's talk about a call. Say the stock is trading at 55. The 50 strike call trading at $6 has a 56 break-even. If the stock is trading at 55 right now, I need the stock to simply trade up $1 for me to break even. If, on the other hand, I look at the 55 call trading for $4, now the break even is 59. The stock has to move to 59 before I see a penny of profit. Well, think about that. $4 on a $55 stock. That's 7 or 8%. The stock has to move 7 or 8% before I make a penny? No. That's ridiculous. That is a ridiculous thing. I don't want to sit there and watch the stock move that much just to break me even. And let's not even talk about the out-of-the-money option. Let's say we're looking at the 60 strike with the stock at 55. The 60 strike trading for $1. My break-even's 61. The stock has to go from 55 to 61. Now, you have to realize that the in-the-money options have much smaller break-evens. The stock doesn't have to move as much for you to start becoming profitable. What does that mean? You have a higher chance of winning and being profitable if you choose the in-the-money option for stock replacement. It's going to make money faster, and it's going to make money more strongly because it has the higher delta, the higher mimicking power than any of the others at the money or out of the money. So that's why we choose the in-the-money option. Now, we know that we're looking for 85 deltas. We know we're trying to time our movement with the same days to expiration. So we have a good idea of the month and the strike. That's it. It's that easy. Let's look at a setup. First thing we're going to do, we're going to use technical and fundamental analysis to identify and find our opportunity. We might go out on our charts and see an opportunity and say, hey, I think this stock is going to go up, or I think this stock is going to go down. For those of you fundamentalists out there, you might have your own reasons why you think something might be going up or something might be going down. We then estimate the timing of the movement. Remember, for all you out there that are looking at charts, what are charts doing for you? Charts are showing you reoccurring price patterns. Patterns that have occurred time and time again over time. So what does that tell me? Well, yes, it tells me, hey, every time that this stock trades down to 50, it bounces back up to 70. Yeah, you're looking vertically. That's wonderful. But here's the thing. Each one of those movements had to take a certain amount of time. Hey, this stock, every time it hits 50, it takes 2 months to get back to 70. It happened here, it happened here, it happened here, it happened here. So now that I sit there and notice the pattern of the price action vertically, I can look at the time it took for that price action to come to fruition. Simple. I now read the chart in a horizontal fashion. I get my opportunity of price movement vertically, and I get my opportunity of timing horizontally. So now I know how long the movement's going to take, and I have a general idea of how far that movement's going to be. So now I want to match the timing or expected timing of the movement with the days to expiration of my option. If I see this movement normally takes about 2 months, right here it was 2 months, right here it was about 7 weeks, right here it was about 9 weeks, right here. Okay, we see that reoccurring pattern. If I think it's going to take about 2 months, I'm not going to jump out and buy a 12-month option. I'm buying too much time. And with that time, that additional time I've purchased, I'm now exposing myself to more volatility risk. Remember, the further out you go, the higher the Vegas. I want to try to match my days to expiration with the timing or the expected timing of the movement. Am I going to be perfect with it? No. But it'll keep me away from saying, I think this is going to happen in 2 months, so I'm going to buy a 12-month option. No. And in the same way, if you think it's going to happen in 9 months, you don't buy a front-month option. You try to match the timing as best you can. Now that you've done that and you found which month you're going to look at, now we go to the 85 delta option in that month. The 85 delta option in that month is the optimal stock replacement option. Yes, you definitely can find a 100 delta option. It will mimic the stock penny for penny immediately. It will have 0 vega and 0 theta. But you didn't need to spend that much money. If you take a look at your sheets, go ahead and bring up your sheets, sheet number 1, and look at the June options. You'll see, with the stock trading at, say, 67.50, you'll see that there are many, I think at least 2, 100 delta options. Each one more expensive than the other. You don't want to be buying the most expensive 100 delta option. If 2 options are going to act similarly, you want to buy the cheaper one. So now you're moving down in strike, aren't you? You start up with the 50 strike and you look at the 55 and go, oh, wow, that's 100 deltas too, and that's $5 cheaper. Let me do that one. And then you move down to what? The 60. Wow, that's about 100 deltas too, and that one's even cheaper. You're going to move your way down in strike. Eventually, you'll move your way right down to the at the money. We don't want to go that far. We don't want to be all the way deep, the deepest in the money, but we also can't be at the money because there's too much extrinsic value. So what are we going to do? We want to try to move down in strike enough, or up in strike, in case of call, enough to escape heavy excess dollar expenditure. But we've got to be up away from the at-the-money strike enough not to get too much influence of the extrinsic value, vega, and theta. So where is that? The area lies somewhere in between. And what I found is, when I take a look time and time again to, hey, I don't want to spend a lot of money, or at least not more than I need to, but I don't want to be at the money. When I bounce up off my at-the-money option, but come down from my deep-in-the-money 100 delta options, the area that I land in, which is the optimal area, always seems to be around 85 delta. Once we've done that, and we know how long this thing's going to take, we sit there and we select the month of our option. It's easy. Let's just say, for instance, I look and I say, hey, this movement should take about 4 months. All the other times in history that this movement has occurred, it's taken about 4 months. So I guess 4 months. Bring up my options. I look. There's no 4-month option. But there is a 6-month option. You know what? Close enough. We buy in our 6-month option. And let's say our 6-month option is, say, December. I mean, what the heck? Let's just make it December. I go into December and I look for the 85 delta option. That's all I've got to do. That's how complicated this is. It's simple. You know where the optimal option lies, around 85 deltas. Does that mean I can't buy the 90 delta option because there's not an 85 delta option there? Of course. I'm not saying it's got to be exactly 85 deltas, you're not allowed to buy it. I'm saying around 85 deltas, maybe 80 as a low, 90 as a high, in that area. But I'm definitely not buying a 50 delta option, and I am for sure not buying a 20 delta option. Somewhere around 85 deltas. In the money enough to have real good mimicking power, but not so far in the money where I'm having to spend a heck of a lot too much for enough mimicking power. Remember, I might be able to get an additional 15% mimicking power by buying the 100 delta option. The only problem is if I have to spend an additional 40% to get the 100 delta option instead of the 85, is it worth it? Should I spend another 40% just to get an additional 15% mimicking power? Heck no. 85 delta option, that's why it's optimal. It's far enough away from the at-the-money option and all that heavy extrinsic value, but it's not so far in the money that it's too expensive and not optimal in terms of cost efficiency. Now that I've chosen a month and I've chosen my strike, I buy the option. The next move is simply adjust the position as necessary. That way, as the stock moves, I'm moving my option. And we're going to talk about the roll in a few moments.